the cost of equity, that is dividend discount model or DDM. You know, DDM, we have used the P0 is equal to, it came from the original formula P0 is equal to D1 divided by R minus Z. Remember, P0 is equal to D1 divided by R minus Z. Now, changing the place value, we can find the R is equal to RS, means cost of common stock. RS is equal to, or cost of common stock is equal to D1 divided by P0 plus growth. And we can also calculate growth by taking this D1 divided by P0 to the left hand side. Then G will be equal to RS minus D1 divided by P0. Like that, we can, whatever we want, we can calculate using the dividend discount model. It is a very useful and popular model in finance. The DDM is an alternative to the CAPM for calculating the firm's cost of equity or cost of common stock. You know, the most two important methods for calculating cost of equity are, one is the CAPM approach, capital asset pricing approach. The other one is dividend discount model approach, or some authors call it as CDGM, constant dividend growth model. CAPM, CDGM. CAPM calculates the cost of equity using the formula risk-free rate of return plus beta multiplied by risk premium. CDGM uses the method, or dividend discount model DDM uses the formula cost of equity is equal to D1 divided by P0 plus growth. The DDM and CAPM are internally consistent, but academics generally prefers the CAPM, and particularly those companies who are not paying dividend, you cannot use the dividend discount model, isn't it? So for those companies who are not paying the dividend, for them CAPM is the best applicable method. And academicians and practitioners, they more prefer to CAPM, and companies seem to use CAPM more consistently over the dividend discount model. And as I said you, if a company doesn't pay dividend, for them dividend discount model is useless. They cannot apply. D1 is not there. So if D1 is not there, how can they use the dividend discount model? So for them remains is CAPM as the best method. Now here is the y-axis consists of the internal rate of return or cost of capital. X-axis represents the beta of the firm. A firm that uses one discount rate for all projects may, over time, increase the risk of the firm while decreasing its value. You see students, before going to the next step, let me explain you. For example, a particular company calculates its cost of capital or hurdle rate or cost of capital or cutoff rate, discount factor, whatever we can call, using the CAPM, RF plus beta multiplied by risk premium. It calculates one rate, and it uses the same rate for each and every project of the company. Is it appropriate? Is it preferred? Is it good? Definitely the answer is it is not appropriate. You should not use the same hurdle rate for each and every project. For example, in this graph, we can find 1, 2, 3, 4. 4 red dots, 1, 2, 3, 4, 4 green dots. And hurdle rate is in between. That means this company has 8 different projects going on. the company is using the single hurdle rate for all these 8 projects. Then what will happen, my dear students? Just imagine those projects which are below the hurdle rate will be rejected, because the internal rate of return here, the project IRR of all these 4 red dots, the IRR of all these 4 red dots means 4 red projects, red dotted projects, the IRR are less than the hurdle rate. And our theory says if IRR is less than hurdle rate, you reject the project. Then those 4 green dots which are above the hurdle rate, that means they generate IRR. Those 4 green dotted projects generate IRR which is more than the hurdle rate. And our theory says any project which generates more than the hurdle rate, IRR more than the hurdle rate, except, that means seeing this graph, we can say those 4 red projects are red dotted projects are rejected, those green dotted projects are accepted. Whether it is right policy or wrong policy, I am not saying. I am saying the company is doing this practice. We will see whether it is doing the right thing or wrong thing. We will discuss in the next slide. But for now, that's why understand very minutely. It's very interesting. In this project, the finance manager has decided that we will have only one hurdle rate. For example, 10% is the hurdle rate. That is the cost of capital, cost of equity. Using the CFIN, one cost of capital is calculated. Say for example 10%. This hurdle rate is used for evaluating all projects. Currently this company has 8 projects. Out of that, 4 projects are giving IRR more than 10%. 4 projects are giving IRR less than 10% if the hurdle rate is 10%. That means theory says because you have taken this 10% as the hurdle rate and unique single hurdle rate for all projects, that means those 4 red dotted projects are below the IRR or below the hurdle rate, reject. Those 4 green dotted projects are providing IRR above the hurdle rate, accept. And what you are doing? Single IRR, single cutoff rate you are using for judging all the projects across the company. What happens next? We draw the security market line. There is a risk-free rate of return, and we draw the security market line as per the tangent line. We just seen in the previous chapter how the SML is being drawn. Now you can see your all predictions became upside down. Why? Those 4 projects which you rejected, they are the profitable one because they are above the SML. Those 4 green dotted projects which you accepted, they are the loss making one because they are below the SML. Anything below the SML is loss making, anything above the SML is profitable, and anything on the SML is indifferent. Isn't it? So, here those 4 projects are which you rejected, they are the profitable one. You rejected the profitable projects. Those 4 projects which you accepted, green dots, they are the wrong projects being accepted because they are below the SML. And the right projects which are above the SML, you rejected. Why? Because you have taken one hurdle rate. How can it be possible? Maybe a company having 3 projects. One is having electricity generation, utility company. The other one is a transport business. And the third one is a retail business. You know, electricity generation company is non-cyclical. whereas the transportation and retail are the cyclical. How can you use the same cutoff rate? How can you use the same hurdle rate? That becomes a challenge now. Then you see, incorrectly rejected positive NPV projects, those four dots which you rejected, they are incorrectly rejected because they are above the SML. And incorrectly accepted those four projects which provide negative NPV because they are below the SML. So this is the way. What we get conclusion from here then? We should not use a single hurdle rate for each and every project of the company. Okay, one general cost of capital you can calculate, then project to project based on the risk involved, based on the leverage of the how much debt equity you are using for the particular project, and how much risk involved in the project, how much cyclical, how much operating leverage involved in the project. Based on those operating and financial leverage and risk involved, you should change the hurdle rate. Either you should increase more premium or you should decrease the premium. How? Let us take an example. Suppose the conglomerate company has a cost of capital based on the CAPM, that is the hurdle rate which we have calculated here. The hurdle rate is 11.1% calculated based on CAPM, risk-free rate of return plus beta multiplied by risk premium. Risk-free rate of return is 2% plus the beta is 1.3 multiplied by risk premium is 7% is equal to 11.1%. Alright, clear? This is the single hurdle rate or the single cutoff rate or cost of equity or cost of capital based on CAPM. Now, this is breakdown of the company's investment project. The company has a operation in different projects. Different type of project the company takes or operates in different industry or different projects. For example, one third of the company's resources are utilized for automotive retailer. So one third of the assets and resources are utilized for retailing business. One third of the business is used for computer hard drive manufacturer, and one third is used for electricity utility. As I said you, little different I said, but I said electrical utility. Electrical utility because it is a non-cyclical business. The operating leverage will be low, non-cyclical in nature, so its beta is 0.6, much lower. Computer hard drive beta is average 1.3, which we have calculated in the previous slide. And automotive retailer, because it is a cyclical industry, so its beta is 2.0. So the average beta comes 2 plus 1.3 plus 0.6 divided by 3 is equal to 1.3. Now, the question is, when evaluating a new electrical generation investment, which cost of capital should be used? Because the general cost of capital as per CAPM is 1.3. Should we use 1.3? Should we use 0.6? Should we use 2.0? Which beta should be taken? Now question is, and next I will extend this question like, if the company is is looking after a new automotive retailer business, what beta it should use? Now two things, if it is taking a new project in electrical utility, what beta it should take? If it is looking for an automotive retailer project, what beta it should use? Now let us take it. You see here, if you are using the electrical utility business, its beta is 0.6. Using the CAPM, its cost of equity or cost of capital is 6.2%. And if a company is in the hardware manufacturing business, 1.3 beta, and the cost of capital will be 11.1, because we have the risk-free rate of return given, risk premium given. So based on the beta, the cost of equity changes. And if it is in the retailing business, you should take the beta of 2, and it will be 16. And you see all these three cost of capitals are falling on the security market line. Based on the risk, the expected return will be changed. Because it is a retailing industry is having cyclical in nature, so the investor in this industry will expect 16%. Because the utility industry is very kind of steady industry, no cyclical, therefore the invest low risky, no cyclical, less risky, therefore the investor will expect 6.2%. So low risk, low beta, high risk, high beta. So if you are taking the question, now go back to the question, if you are taking a electrical investment or generation project, then you should take, your expectation should be 6.2%. And you should calculate the NPV on the basis of 6.2%, not on 11.1 or 16. If you are taking a retailer business, retailer project, then you should take the cost of capital as 16%. And if you are taking a hard drive manufacturing project, you should take 11.1%. So you should not use a single hurdle rate for all the projects. Or else what will happen? The profitable projects will be rejected, the loss-making projects will be accepted. So to avoid that, we should adjust our required rate of return based on the beta of the project. So here, because you are an electrical utility, you are looking into a project in the electrical utility industry, you should take 2% as the risk-free rate of return given, plus 7% risk premium given, multiplied by the beta is 0.6 is equal to 6.2%. If you are taking a retail industry, the same 2% plus 7% multiplied by the beta is 2. 7 multiplied by 2 is equal to 14. 14 plus 2 is equal to 16%. Like that, based on the risk, the beta will be calculated, and based on the beta, the cost of equity changes, hurdle rate changes. Therefore, investments in hard drives or auto retailing should have higher discount rate. Investment in the electrical utility generation company, you should take lower cost of capital. Now we should take, just let me ask you, just take a minute.